Hello, everyone, and welcome back to Motley Fool Conversations. I'm Motley Fool contributing stock analyst Rachel Warren, and today I'm delighted to welcome Gargi Chaudhuri, BlackRock Chief Investment and Portfolio Strategist for the Americas, to the show. Gargi has over 2 decades of experience in the financial services industry. She's built her career around portfolio management in the fixed income markets, trading, and macro strategy. She joined BlackRock's Global Fixed Income Group as a sector specialist in 2010. She transitioned to the Global Inflation Portfolio Management team as a senior portfolio manager in 2013, and from 2017 to 2020 served as a member of the fixed income product strategy team. Prior to joining BlackRock, Gargi spent 9 years on the sell side at Jefferies and Merrill Lynch, and as a VP at Jefferies, she ran the U.S. inflation trading desk and built the Treasury Inflation Protected Securities franchise. Gargi, welcome to the show. Really delighted to have you here with me today.
Hi, Rachel. It's wonderful to be here. Thank you for having me.
Absolutely. Well, I want to go ahead and dive right in. BlackRock just released its most recent report, Investment Directions 2026 Outlook. So essentially the outlook for the year ahead, which you co-authored. And there are really so many important takeaways in this report for the broader market, for retail investors that I want to spend time on today. There was one part from the report that really stood out to me. It notes, we believe 2026 will be characterized by above trend economic growth, easing policy, and accelerating productivity. We believe this backdrop favors risk taking, but weakness in the labor market, rich valuations, and an uncertain forward path for interest rates remain risks. So I'm curious, what specific data are you seeing that can really confirm that this acceleration is sustainable? Is it broadly based across numerous sectors, or is it mainly concentrated in tech?
Sure. And Rachel, to your point, my team and I have, spent a lot of time over the holidays working on our 2026 investment directions that came out on January 5th. And the main thesis, to your point, is just that the backdrop that we are entering 2026 into is a really favorable one for investing in equities. And the reason that we're laying that out in our report is that, especially when compared to this period 12 months ago in 2025, we're not just seeing strong growth, we're actually seeing growth accelerate. And then coming directly to your question, it's not just about the AI capex that is driving investment and as a result GDP. It's not just about that. Even though that is a really strong and big driver of the economy, it's more than just that. It is the recognition that accelerating productivity is going to be a driver of GDP. It's the recognition that the consumer has still been in a very solid footing. And if we look at sort of expectations of Q4 GDP as well as Q1 GDP of 2026, which of course will come out in a few months now, in 1 quarter from now, the consumer, you and I, people that spend on the economy that drives a huge amount of economic growth, we still feel good about being able to spend. And on top of that, as we lay out, it's accelerating growth, but at the same time, expectation of interest rates continuing to move down. Obviously, that's something that we saw in 2025 as well. And we expect that to remain the case. And the combination of those two, where growth not just is strong, but accelerates to call it 2.5, 2.6, 2.7% if you look by the end of 2026, but the policy rate also comes down. Those two things don't happen simultaneously very often. And that is what makes this a really rich environment for investors to invest across markets and equities, in bonds, and in some other what we call diversifiers. And then maybe the last thing that I'll add for our listeners is just a recognition that this time last year, there were a lot of uncertainties that you might have been thinking about, whether those were related to what might happen if tariffs come through, what might happen if inflation accelerates further as a result of that. And some of those concerns actually being in the rearview mirror now. So getting a lot more certainty around the impact of tariff that allows corporations and us, frankly, to feel a little bit more confident. Alongside that, the impact of the Big Beautiful Bill Act and the expectation of growth coming from some of the tax benefits from there are all other drivers of growth. So again, a pretty strong economic outlook from a GDP perspective, rates moving lower, coming from broad economy, not just a few areas. And that is the foundation for our view on asset classes across equities, fixed income, and other diversifiers.
Yeah, that's a really helpful explanation of sort of the foundation of some of the methodology in the report. And I want to go back to one of the things that was noted there, talking about rich valuations. Are there really specific asset classes or sectors where you're seeing those, valuations looking to be the most rich? And is there a point at which these valuations could move from, being a risk to a correction trigger that could outweigh the positive economic backdrop? What are you seeing there?
Yeah, so we talk about rich valuations, and if you read through the report, you'll recognize that we address rich valuations and then we bust the myth around it. So it's not necessarily rich valuations all across the board, and that's why you should be scared and stay in cash. But it's a recognition that the world today that is driven by AI, and the stock market today that is driven by AI, the tech market today that is very cash flow rich. And we share some of the net income growth numbers that I'm sure we'll get into in just a second, and the income growth, the earnings growth numbers that are actually making valuations more attractive than they were at the start of 2025. So it's not just that, on the surface, we do hear from our clients a lot of concern over just the level of the S&P 500. And if you just look at the 12-month forward PE, that actually being at levels which perhaps we haven't seen in some time. And that is one of the concerns that we hear from clients. And I think what we try to highlight is, look, we recognize that you might be worried about just the top level, just the number, the 22-ish, 22 and a half-ish number, but then let's break it down for you. If you look at tech particularly, and large cap and growth particularly, if you look at tech, for example, because earnings growth has been so very strong over the course of 2025, and of course, we learn more over the next few weeks and months on Q4, because earnings have been so strong. If you look at the PE, that's actually come down for tech from where it was in the beginning of 2025 to where it was in the beginning of 2026. That's moved lower from about a 27 and a half, it's actually, or 28, it's actually moved down to a 26. So the earnings growth here is the story that matters. So of course, there's always reasons to be a little bit concerned about pullbacks in the equity market. And everyone that's listening, I want them to recognize that it's not a given that equity markets will always just go up and up and up. We've had that delightful experience over the last 2 or 3 years, and that's wonderful. Over the long term, broad equity markets, if you're diversified with ETFs and if you're invested in a diversified manner, over the long term, you do have that positive return. But recognizing that there can be periods of pullback in the markets, not only are they common, they can be healthy. And we just recognize rich valuations as a way to sort of maybe myth bust a little bit around tech valuations, but also recognizing that pullbacks are a very common, necessary, and normal part of any stock market performance. And if you're invested in a diversified manner across not just asset classes, so bonds, international equities, US equities, as well as some other diversifiers such as gold, such as Bitcoin, such as liquid alternatives, you will and you should, or you could have over the very long term, have a positive journey.
I want to talk more about the AI piece here. Obviously, I think that's something a lot of investors are paying attention to in the current market, but it's something that your report focuses on quite a bit as well. And there's sort of one section of that I wanted to read where the report notes artificial intelligence remains the dominant theme for investors as it catalyzes a capital-intensive expansion, boosting productivity and sustaining earnings strength. With over $500 billion spent on data centers in 2025 alone, and another $5 trillion to $8 trillion in and overall AI infrastructure spending expected through 2030, capital expenditures underpin not only corporate profit expectations, but indeed macroeconomic growth forecasts. And one of the things that really stuck out to me after reading that is, we've seen many of the major tech giants are very successfully capitalizing on the AI revolution. It's not the case for all AI businesses. A lot of the investability now does lie around these very established figures. I expect that will change. But I think one question that sort of comes from that is, how long can investors tolerate earnings strength sustained by capital spending before they maybe demand proof of direct revenue from AI products? And in what ways is AI-driven capex sort of reshaping corporate priorities as you've seen it?
Yeah, excellent question. And maybe there are many parts of that question. So if I can parse through that a little bit, one of the things that we look at is specific AI related stocks. So we looked at the broad S&P 500 and looked at the names. There were 46 AI related stocks within that in the large cap. Obviously, it's the S&P 500, so it's in the large cap space. Of those 46 AI stocks, about 44 of them had a drawdown of at least 20% in 2025, yet 19 of those 44 managed to also post a total return of over 20% for the year. 12 AI stocks actually had negative performance. And we highlight this just to show that AI is not a monolithic theme, right? So a little bit of an active management within that theme. And the ETF ticker that we focus on here is BAI, which is the BlackRock AI actively managed fund, which is able to, again, actively manage around different portions of that theme. So obviously there was a period of time when people were focused on just the software aspect, and now it can be about memory, and obviously chip has always been a story. But is there also more and more in 2026 focus on power and the needs of power? And hopefully we get to talk a little bit about that, but that can continue to evolve, and being able to shape a portfolio strategy as the narrative around AI evolves is really going to be important in 2026. And I think we saw that in 2025 as well. So that's number one. Number two, really great question around the AI capex cycle. I think we've seen this over and over again, that investors are no longer giving that AI spend an open-ended grace period, right? So early in the cycle, when we were first learning how to use ChatGPT for cooking and planning vacation purposes, perhaps, early in the cycle, I think we were all in the market, the market was willing to reward the scale building and capacity creation pretty meaningfully. When we saw those headlines come across around, hey, there's another 250 billion deal, I think that was viewed pretty much as like positive news. Mm-hmm. I think that is shifting a little bit in in this year, and certainly the second half of last year. Today, I think investors do demand evidence of monetization, of growing revenue, of improving operational leverage. And I think that's important. That's an important differentiator from the early AI capex story versus the 2025 and what we think 2026 will be. So I think what we should all focus on is, as we're entering this new regime of where, it's not just go and spend, which are the companies where capex is tolerated or not tolerated, but funded by and leads to cash flows. There's a lot of free cash flow. And you're not seeing the revenue deterioration as a result of capex spending. What you're able to see is AI stocks that are able to sort of monetize effectively and showing proof in their income and showing proof in terms of future, future direction of where this will result in monetization. So I think that is going to be a big differentiator going forward. And I think that maybe the third theme that I would focus on is sort of the differentiation this year, I think, which is going to be around just AI spend versus AI adoption. And I think we're already kind of beginning to see that a little bit, where there is a very prevalent theme of a broadening out in markets this year that wasn't there so much in 2024 or 2025. So as more and more companies begin to use AI for all of their functions, we will see productivity enhancement across the economy. And that will lead to sort of that AI lifting all boats, if you will, that AI tide lifting all boats. And that's going to be good for a healthy market across all different sectors, or many different sectors, maybe not all different sectors.
One of the things that I thought was really interesting was you noted in the report that AI stocks have grown earnings markedly faster than their non-AI counterparts since ChatGPT was released, which perhaps might be surprising to some investors. So the report noted that the 46 stocks in the S&P index that you identified as AI stocks grew their aggregate net income by 30% per year between 2023 and 2025. And that was compared to just 3% for the non-AI cohort. This AI build out, as you also note in the report, it's in its early stages. It's expected to continue to drive growth in many quarters and years to come. So what do you view as being these key drivers and detractors of growth and of profitability?
Yeah, absolutely. So, those numbers that you laid out, again, to reiterate, that 30% versus the 3% in the non-AI cohort, that's actually sort of, an eye-popping difference, right? And I think two broad things before I get to the drivers and detractors. I think that we need to be singularly focused on how that is changing. So are non-AI parts of the market able to have some earnings growth in 2026? And actually, we're seeing some signs of that. So the gap between that 30% and 3%, it's certainly true that the AI stocks are growing their earnings much, much faster. But what I think we'll see for the remainder of 2026 is that gap will narrow ever so slightly. The gap will still remain, but narrow, and I think that's a really good sign for AI adoption, as I pointed out. Coming to the second part of your question, which is around the detractors as well as sort of the drivers of growth, if you will, I'd say that the primary drivers of AI-led growth, thinking about accelerating enterprise adoption, right? So agents, automation, vertical specific AI, that's all like the top of mind for investors. And alongside that comes the physical build out of the infrastructure around AI. What does that mean for the industrial cycle? And I think that's playing out very, in front of our eyes when you look at some of the returns year to date around parts of industrial metals. Yes, precious metals have had an incredible year, but industrial metals have had too. And just when you look at industry breakdown of the S&P 500, also looking at utilities and materials, industrials, these parts of the market doing very, very well in 2026 is again another sort of evidence of this driver of the AI-led growth. Obviously, as you're talking about drivers, you also have to keep in mind what some of the detractors could be. And I think there are two ways to think about this. First is a recognition that the power and energy constraints are very much things that we all as investors have to have a plan around, have to be very pragmatic around. We do think that going forward, a lot of spend on building the infrastructure needs, building the power needs will come through globally. This is not just a US story, but this is a global story around where money is being spent on different types of physical and digital infrastructure, on different types of pipelines, if you will, to allow for the power to get from one place to the other for the AI build out. But that could, if not done quickly enough, could be a constraint. So keeping our eye on that, but also trying to focus on that from an investment theme perspective could be around focusing on infrastructure build out. We talk a lot about one of the ETF tickers related to infrastructure, which is IFRA, which again gives you that allocation to infrastructure as a mega trend that is shaping this AI theme. And then I'll also say maybe the last thing is recognizing that the AI-related capex cycle will have a debt associated with it. We've already seen many issuers come to the fixed income market or even to the private markets to sort of raise money. And this actually, I think, creates an incredible opportunity for investors that might not have usually focused on fixed income as an exciting place in the market where, obviously it's not as sexy as equities are, but recognizing that having this new source of supply that can be very tied to this exciting AI theme can again make sort of income generation in the fixed income markets tied to corporate credit related to technology spend in AI specific names that could create another opportunity. So broadly, think about the accelerating enterprise adoption as an area of growth, thinking about the infrastructure build out and the energy constraint as something to keep at the back of our minds. But of course, where there's a risk, there's an opportunity as well. Focusing on the infrastructure build out, both in the public and private markets, as an opportunity for those of us that are able to participate in it. And obviously, IFRA is one of those stickers. And then lastly, recognizing that there is a role for fixed income and the debt markets to play. And for those of us who may not have thought about fixed income markets, reapproaching that, especially given some of the yield levels that exist in the fixed income markets these days.
And it does seem as though AI has become the dominant theme in the market, particularly the last couple of years. But of course, we're also in a day and age where, and your report takes a very holistic view of the market in the year ahead. There are a lot of different ways to invest in the power and the growth of the stock market besides AI. So kind of as we're thinking about this as investors, what are some ways we as investors can, diversify to avoid some of these high concentration risks?
Yeah, absolutely. So if you have the AI, if you are looking at your portfolio and if you have what you think is a lot of the AI trade already, that's when you might want to think about moving away from it. Now, I'd first start with AI is a theme that's really going to change our lives pretty meaningfully over the next decade or so. It's going to change the economy. It's going to change the way in which we operate. So having your investments tied to AI is of paramount importance. And that's why we sort of think about that as being one of the best trades out there, but it's not the only theme out there. So if you have enough of it, let's think about what else in the market could sort of diversify your portfolio from the equity standpoint. So here's where we talk about three themes. One is just a resurgence of our view in the value sectors of the economy. We talked a little bit about earnings growth earlier, just to point out that for 2026, growth earnings expectations still outperform value earnings expectations. So growth is supposed to grow earnings at about 19%. Value is supposed to grow earnings at about 12%. So, growth certainly outperforming value. But that 12% number is a meaningful shift from where it was just 2 years ago. We were at about 3% in 2024, and that has moved significantly. So the market often doesn't just focus on the level, it focuses on the change. So value is an area of the market. If you want to diversify away from the AI theme, that's an area that you could. Another theme that we're talking about, in addition to AI, and by the way, if you're thinking about value, one of the tickers that we tell investors to focus on is IWD as a way of getting that value exposure in your portfolio. And then the other one is really thinking about dividend stocks. Again, if your company is paying out cash flow in the form of dividends, hopefully it has cash flow and it hasn't tied a lot of it in AI capex. It's giving you that inflation protection in your portfolio as well, typically. And again, a way in which we're thinking about dividends is via HDV, which is our dividend ETF, which gives you a very different exposure to what's in AI. And then the last one I'd say is international markets, specifically around emerging markets as a theme. Most US investors, we find in some of the portfolio level work that we do, most US investors have a huge amount of focus in US only, which has worked out brilliantly for you. So if you do have that, congratulations, you've done very well over the last decade. But certainly in 2025, we did see that emerging markets had that outperformance versus the US, and many parts of the developed markets did too. So reconsider the role of emerging markets in your portfolio, especially given that the macro backdrop is so positive for EM right now. And there we're talking about IEMG as one of the themes and one of the tickers that you might be able to have in your portfolio.
One kind of final question on the AI piece, because I think this is such an interesting conversation, and you sort of hinted at this, but obviously, investors need to discern between companies that are simply using AI for, say, minor internal efficiency gains. Nowadays there's so many different stocks that are referred to as AI stocks, but in some cases it might just be, moderate internal changes they've made versus companies that are building those very core, proprietary AI models, infrastructure, as you've talked about, platforms that offer a durable competitive advantage. So there are some key differences amidst the range of companies that are in the market that are posing themselves as AI plays. So for those that are investing in the AI theme, what can we look for when we're trying to identify these winners and losers in the market? What are the types of companies and business models that we need to be paying attention to?
Yeah, and you know what? This is why we sort of shed some of the data around what did that 46 stocks in the AI basket in S&P 500 do in 2025, just to show you that it's not a monolith. There's already dispersion within the AI theme. And maybe the one thing that we would say is obviously, focus on an active approach to AI, whether by choosing an active manager or if you're able to by yourself do that. We talk about a few ways to do it. The few things you should focus on, but recognizing that the theme will rotate. It won't be the same thing. The theme might have been in 2024 just about the chip manufacturers. And that theme then broadened out into, yes, the chip manufacturers, but also the software angle. And now that's moved from memory and data. And then that's moved again into sort of the power generation capabilities. So the AI theme itself will evolve. So recognizing and being up to date on how the theme is evolving, and then focusing on, again, like I said, if you're able to not pick an active manager, such as focusing on BAI, if you don't want to do that, then focusing on the clear AI-linked revenue exposures, the pure thematic, we call that thematic alpha. Focus on the consumer demand, focus on sales growth when the companies are, reporting their earnings. Look at that revenue from AI and look at where the losses are coming from. Are they coming from things that are related to AI? Are they coming from things that are related to the heavy capex cycle? Is it a vague sort of, we use AI for this, but actually you're not able to pinpoint as you're doing your own internal research around how exactly the company is monetizing and able to show revenue. So maybe those would be some of the things that I would focus on if trying to parse through which are the true AI winners, if you will.
Yeah, I think that's incredibly helpful. One of the things as well that the report highlighted was, easing policy rates should prove a boon to risk assets broadly, but this can also present some challenges for income-oriented investors. We've talked a bit about, dividend stocks and equities today. And of course, BlackRock and you advocate for a whole portfolio approach to income. I'm curious, what market trends do you see as being an important focus for long-term investors as, major central banks are turning a bit more cautious, even amidst, continued hopes for easing rates?
Yeah, so I think a couple of themes that we're watching is obviously, the decline of inflation. So inflation, when we look at our expectations by the end of 2026 versus where we were coming into 2025, there has been a gradual deceleration of prices, and we expect that to continue. Into the end of 2026, we expect inflation to get down to about that 2.5% level. Now, when I say this, I know some of you might be like, oh, wait, my smoothie is still $15. Yes, I know, and that sucks. But at the same time, it's, when we are thinking about inflation, it's not the actual level, it's the price change. So recognizing the level is still high and painful, but that the price change has stalled off a little bit. So our view is that inflation will continue to moderate, and that actually allows for the U.S. central bank, which is the Fed, of course, to have more tools, to have more ability to ease policy, especially if there's a risk. So now we think that they will cut rates two times in 2026. But if we are wrong in our view that the economic growth is actually quite accelerated and will accelerate in 2026, if we're wrong in that view and the labor market gets a shock, then the Fed is in a place where they can cut even further than those two cuts that we're talking about. So that's something that we are watching and we're paying attention to in terms of thinking about income. And the second is just recognizing that there's about $9 trillion worth of cash sitting on the sidelines. So investors did make a very thoughtful decision to asset allocate to cash when interest rates were sitting at 5.375%. And they continued to do so because we were used to a world where you only got about zero or a little bit higher than zero in your money market funds, and recognizing that cash was a very deliberate choice for many investors as a way to diversify. Now we're in a new world now. Rates are already lower and they're going to come down even further. And this 9 trillion that's sitting on the sidelines, some of that, not all, but some of that will have to find a home. And we think that, you're not going to move from cash all the way to Bitcoin. You're going to actually start off with some allocations to perhaps income strategies. And this is where focusing on fixed income, and the ticker that we tell investors to think about when it comes to income is BINC, which is the BlackRock Income Fund, or even thinking about something which is a little bit more equity focused. So using equities for your income allocation. So using options as a way to generate income in a portfolio is something that's really, really important for investors. And we've actually seen a lot of flow into tickers such as BALI, which is BALI. And then the last way, and we spoke about this a little bit, so we've got the fixed income source of income, we've got equity source of income, and then we've got dividends as a source of income. So this is where HDV comes in as, again, another way in which you can diversify away from that AI story, but B, get that dividend allocation in your portfolio to round out that multi-sector, multi-asset income generation for those that are looking for it, especially if you were using cash as a source of income.
The other thing, and you mentioned this a bit earlier, was that the backdrop for global investing is shifting after a stronger run for international markets in 2025 than perhaps you would have anticipated a year ago. And as a softer US dollar may still support international exposures, the return boost from outright depreciation is unlikely to be as powerful as it was in 2025 in your view and based on the report. And something else you noted is that this requires a greater emphasis on selectivity. So, what criteria should investors be prioritizing to find companies likely to succeed in this environment? Does it require new portfolio construction tools as we are looking at this evolving landscape?
Yeah, with respect to sort of new portfolio tools, I'd just say the one theme that comes up over and over again is, a lot of investors had focused just on bonds and stocks for a really long time as the two engines of growth for their whole portfolio. And obviously 2022 taught many of us a bitter lesson in terms of stocks and bonds don't always move in that opposite direction, which led to many investors looking for other asset classes. And one big theme was actually gold, and the other big theme was Bitcoin. To add that something a little different in your portfolio that allows you to have a differentiated source of return in your portfolio when stocks and bonds are going in the same direction. And usually that's a concern when it's going in that negative direction, right? So number one, recognizing that there is a role for other types of asset classes that have a lower correlation over the long term to stocks and bonds, and adding a sliver of that in your portfolio. So we recommend investors do that. And then the second thing, which is just recognizing that most investors, and we talked about this a little bit ago, but most investors have most investors in the US have a US dominant portfolio. And, we do a lot of client calls where we poll our clients, and, we also sort of look at portfolio holdings of our clients, of advisors and institutional clients. And we find that similar theme where there is a focus on the US, and we see that overrepresented in portfolios. But recognizing that international markets, and especially in our polling insights, clients tell us that emerging markets is the area that they're most interested in 2026, and we see that in flows as well. Recognizing that a period of growth moving higher, policy moving lower, the dollar remaining stable or actually moving lower can be very beneficial for emerging markets. And that can actually, in periods of distress in the markets, can show a lower correlation than some of the small cap areas of the US equity market. So international, not only is that diversified source that's a little bit different, but it can also actually do something that's a little different from things like small cap, which many investors also own.
Now, I want to talk a little bit more about emerging markets. I think that's a really interesting subject because, as you noted, a lot of U.S. investors invest in U.S.-based stocks, and that's very much true, of course, in the Motley Fool U.S. universe. But you note in the report that in Asia, emerging markets may offer a key source of earnings growth and differentiation across a range of sectors, including AI. One of the kind of statistics that stood out to me was that emerging markets now account for about 41% of global nominal GDP, and that's been broadly supported by easing financial conditions, recovering exports. What can you tell me about some of the key growth tailwinds there and the markets and sectors that are of the most interest?
Yeah, so I'll go broad and then narrow. So from a broad perspective, obviously, we all know that what drives economic growth in any country is the number of people, so demographics, and how hard they work, i.e. productivity. So that is how you compute GDP for any nation. And as we know, in the emerging markets in countries like India, for example, you do have a younger working population. And more sort of tactically, if you will, what drives emerging markets, one of the biggest driving factor of emerging markets is actually what developed markets are doing. So developed markets, such as the US, having a strong growth backdrop is actually a really, really strong tailwind for emerging market performance as well. On top of that, the third thing would be what currencies are doing, obviously. And like last year, where we saw emerging markets and, frankly, developed markets, ex-US, outperform US, a big tailwind was the US dollar declining as significantly. Even if this year we don't see that, or we just see a more stable dollar regime, the macro backdrop is strong enough. The demographic picture in many regions of emerging markets is strong enough that emerging markets can still have that outperformance. And then maybe to go from broad to narrow, what we often sort of forget is the reason of the cyclical upswing that we mentioned. Part of that is actually related to AI as well. You may not necessarily think AI when you think emerging markets, but if you think about countries such as Taiwan, such as Korea, there is a huge amount of AI-related growth opportunities that is coming. And the ticker that we think that you should focus on if you're looking at Asia-specific countries as a diversifier in your portfolio is AIA. Which again gives you Asia exposure in your portfolio that you may not have necessarily thought of as an AI theme. One of the things that I thought was very interesting in our first client call of the year, when we launched investment directions, what we saw was most investors that responded to the client questions that we asked around, what are your thoughts about AI? Do you want more exposure to it? Do you want less exposure to it, or do you want to diversify within the theme? About 50% of the respondents said that they like the AI theme, they just want to diversify within the theme. They don't want to move away from it, they don't want to add, they just want to diversify within it. Asia could be a great opportunity to diversify within the AI theme. You still get exposure to it, but it's not the Mag 7, if you will. Similarly, infrastructure and power are great ways to diversify within the theme of AI without specifically focusing on, chip manufacturers.
What sectors, both in established as well as emerging markets, are you seeing that are delivering the most meaningful earnings growth outside of the AI theme, or is a lot of it concentrated around AI right now?
I mean, certainly, we're very early into the Q4 earnings season, but certainly, and the next couple of weeks will be really important, but just based on expectations, to be clear, tech is still where much of the earnings growth is coming from. But the difference this time around is that there is strong earnings growth in other non-AI sectors as well, which wasn't the case in 24 and 25. Materials, utilities, financials are some great examples of sectors in the US that are actually delivering high single-digit growth in earnings. That was not the case in prior quarters and prior years, but that's turning now. But again, I do want to highlight that these are they're not higher than the growth and the tech earnings. It is just a change. It's not an absolute number, but the relative number. So from a relative perspective, as I pointed out a little bit earlier, value relative to growth is two broad ways in which many people that are listening probably think about the world. Growth is still growing or expected to grow at that 19 to 20% earnings per year, whereas value has moved from 4 to 8 to 12 in the last 3 years. So growth is still sort of the higher number, but the gap is slowly shrinking. If you go back to 2024, value was at, call it 0 to 1%, and growth was growing at over 30%. So that gap was 30%. Right now it's 19 versus 12. So that gap has shrunk from 30 to 7.
One of the things that I think we as investors have noticed, but also, of course, your report highlights, is that returns are often more sensitive to changes in expectations. Market performance doesn't always mirror the level of earnings growth. History has shown obviously a positive long-term correlation between earnings and returns, but short-term disconnects seem to be very common. So how can long-term investors approach this phenomenon? I think it's been particularly apparent in the market cycles of the last few years.
Absolutely. And I think that this is where a little bit of market psychology comes into play, where especially because we've had 3 incredibly strong years in the market, our brains might be wired to think that everything's only going to go in one direction and that direction is going to be upwards. And I think recognizing that when the fundamentals are strong in the market, which obviously is, it is right now, as we point out in our report, the fundamentals are strong from a GDP perspective, but also an expectation of earnings perspective. When the fundamentals are strong, even if they are dislocations, and we saw that last week, and frankly, we're going to see that, I'm sure, many times this year. And I think the best example of this is April of 2025, where the fundamentals of the US economy were very strong. The labor market was strong, GDP was expected to be positive, and the Fed was very much in a place where they were able to deliver rate cuts. The market had a pullback, and it was a very strong pullback. And then it did gradually recover, not even gradually, meaningfully recover from the bottom seen in the first week of April throughout the rest of the year. So I think that recognizing that the market will not and should not always go straight up in one direction. And we've been very lucky that that has happened over the last 3 years, but that is not always the case. There will be periods of time where there'll be volatility that could be related to geopolitics, that could be related to a data point, a labor market report, or a inflation report that could drive the sentiment one way or the other. It could also be related to micro factors like earnings misses, where you can see one company or a handful of companies missing significantly or significantly disappointing the market. The miss might be not very much, but the expectations were so high going into earnings seasons to see revenue growth of X and capex of Y that missing just by a few basis points could lead to a whole massive chain of reactions in the market. I think taking that in stride, separating the signal from the noise, is this noise? Is it just an expectation management issue? Or is this a pivot in the market where now we're no longer believing that X is going to be an engine of growth anymore? And I say X now because that could be anything depending on the month or the year. So recognizing that sometimes there's just noise, there's positioning. A lot of people are positioned in one way, and when the market starts moving, you sell what you own. And even the fundamentals can be strong, and that can still move lower in price because people sell what they own. Recognizing that if the fundamentals for that thesis remain solid, you need to sort of stick with your investments and think about the longer term. And obviously, that's easier said than done. This is where having that diversified set of stocks, bonds, other diversifiers in your portfolio comes in really handy. So if one part of your portfolio, if your AI related stocks are doing not so well, hopefully your value related stocks or your international stocks or your bonds related to income generation or your gold allocation or your Bitcoin allocation are diversifying your portfolio enough to weather the storm.
One final question as we draw to the end of our time together today, looking ahead, to the end of the decade and beyond, what are the themes, whether in or outside of AI, that you are the most excited about, that you think will be the most significant market drivers?
Sure, I love this question. I think that as we think about the end of the decade, I think it's going to be not just about, AI is going to, I think, be with us, but it's going to be the adoption of AI and the way in which it enhances productivity across many sectors. So when we think about what might healthcare look like with AI making things more efficient, what might even financials look like with all of us having this incredible tool that we've learned how to use effectively, and how you and I are more productive as a result of that. So it's not AI specifically, but it is the benefits, the adoption beneficiaries of AI, and how that's permeated across the global economy. So that's something I'm really excited about. That's number one. Number two, I think that we have often, and in this conversation, I think we focused a lot on the United States, but I think recognizing, as we do in our report, that so much of global GDP is coming from outside of the United States. And especially with AI being such a dominant driver of markets, so much of the AI innovation that is coming from other corners of the world can actually result in portfolio gains for you, will be a theme that we, by the end of this decade, will certainly have wrapped our heads around. So that's number two. So opportunities, yes, in the US, but not just in the US. And then maybe the third thing that I'll focus on is recognizing that, there are consistently demographic shifts that we focus on, that we forget to focus on, and then we focus on again. And at the end of the day, like I said, what drives growth for economies? It's actually how many people a country has and how effective or productive they are. So the productivity thing, I think, is solved with, or not solved with, but certainly aided with AI. But on the demographics, I think turning our minds to countries that have a younger demographic, that are now, sort of over the next 10 years, that are countries that will have the most amount of people that are between the ages of 25 to 40, for example. I think that's going to be a big driver of growth. And then again, focusing on countries like India, for example, as a driver of growth. And we focus on a ticker INDA, which gives you exposure to Indian markets. I think that's going to be countries with young demographics is going to be something that we more and more focus on over the next few years.
Well, Gargi, I think you have given our viewers and listeners so many helpful tools and insights to glean today as we continue on our long-term investing journey. Thank you so much for joining me on the show. It's been a pleasure to speak with you.
Thank you so much for having me.